Jim, thank you very much for joining us today. You're currently in Sonoma County. Why?
Because I can be? Is that a good enough answer for you?
That's a great
Um,
answer.
the truth is, we're empty nesters. My youngest is a freshman in college, and my wife and I said we're going to do something different. So we ditched the cold weather in Chicago for a couple of months out in Northern California. Yesterday it was 88 degrees here. It's a little cooler today and raining, but I've really enjoyed the change of pace.
Yeah, it's a beautiful part of the world. I've been to Sonoma and Napa a few times, and I just love it there. It's so relaxing. It takes you away from all the politics and business and Wall Street and all the chaos.
Yeah, exactly, exactly. As far as, and then coming here in the winter when it's a little quieter, is been a big. It's been nice too, just to get away somewhere it's quiet.
So, Jim, I want to get your views on the economy. And we recently had a meeting with the Fed, and Jerome Powell provided some views, I guess, on what he and his team are thinking about the economy. And I was really surprised to see them take their growth assumptions for the US economy down. It went from 2.1% down to 1.7%. And at the same time, they took their inflation targets up from 2.5 to 2.8%. And Jay Powell expressed a lot of concern about the uncertainty that's being associated with the tariffs. What are your views on that Fed meeting and the comments from Jay Powell?
I thought I had a different take on that Fed meeting because people looked at that meeting and kind of came away with the idea that the Fed was going to be dovish. And they looked at it because of the growth assessment being lowered. And of course, that they still had the rate cuts factored in on their dot plot as well. But I looked at it with the bigger problem I think the Fed is going to have when we go forward from here is they took their inflation estimate up. Even though he dragged out the transitory word again, you would have thought he would never have used that word again. Taking those inflation estimates up is I think going to start to be really problematic for this idea that the Fed needs to be cutting rates or lowering rates. February marked, I'll give you one statistic. February marked 47 consecutive months that core inflation in the US was above 3%, core CPI. They're talking about that inflation is going to return to its 2% objective. It's been 5 years and they can't get it below 3 at this point. And the inflation rate seems to be bottoming out at around 3% on the core level. Now, that's been my forecast for a long time, that I've always argued that inflation is going to be 3 something or another and not under 2. And that if it stays at 3 something or another and you put R star on it, R star means 3% inflation, add 1% to that number, that the neutral funds rate is somewhere around 4, and they're 4.25 right now, that they're pretty much done cutting rates. And I think that that's really the way that I took away from it, is that I think the bigger problem the Fed has is that stickier inflation. And that's why I thought I leaned a little more hawkish about that meeting. Seems like the market might be coming around to that viewpoint because after bonds initially rallied off that meeting, they've backed up all the way to about 433, to 435 on the 10-year note, which is flirting with a new 1 month high in yield. So they're kind of going in that direction. And recent Fed speak has been also opening up to concerns about inflation.
And so I want to ask you now about the U.S. consumer. And even though the U.S. economy looks like it's doing okay, growing at 2.5%, it looks like there's elements of weakness out there. And I'm looking at the U.S. airlines. We had profit warnings out of Delta, American, Southwest. All of them cited, especially Delta, said there was people aren't flying business class anymore because of this uncertainty that we're going through. You look at the retail numbers. We just had another retail company, Forever 21. I believe they sell to young women, but they just declared bankruptcy for the second time. And we've had numerous other retailers go out of business here in the past year. And in 2024, 7,300 retail stores have shut down. Industry experts are expecting that number to double in 2025. And I know a big part of it has to do with the shift from brick and mortar over to e-commerce, but nonetheless, there's still a lot of businesses going out of business. People are out of work. I saw an interview with Warren Buffett recently. He was asked about his views on the US economy. He declined to answer. But I think if you look at what he's been doing in the past year, selling down all his stakes, raising cash, currently sitting on around 28% cash in his portfolio, he's concerned about the economy. Are you concerned at all about the health of the US consumer?
Well, you're always concerned, and you're right that the retail data is difficult to kind of discern because Challenger Grain Christmas, which gives the layoff announcements, showed that there's been a big surge of layoff announcements out of the retail sector. And the question is that because the business model of retailing is changing, as you mentioned, from brick and mortar to more online? And that's why we're seeing these jumps. Or is it a case that what we're seeing is some kind of a marked slowdown? I think it's more the former. That is that it's more about the business model being changed. The consumer, yeah, there is a bit of a concern out there about tariffs because what Trump is doing with tariffs, his relationship with Europe, his relationship with Canada, and a lot of other things is unprecedented. And so it's got people worried or wondering where we're going from here. Throw in the uncertainty of, or the discomfort that people have had over a 10% correction in stocks. And I think if you sum all of that up, that's what we're starting to see. But if you peel that back, yeah, you're right. The airlines have given a lot of profit warnings. Yeah, the airlines are saying that people aren't traveling as much. But let's go back to the second half of 24. We had booming record travel in the second half of 24. So maybe they've already had their vacation. They've already, done their business trip. And that's why that we're seeing this slowdown. And also it's seasonal too. The winter months tend to be a little bit slower. What I'm trying to sum it all up with is I think that, from where I'm sitting, the consumer is still okay and the consumer is still moving forward. The last thing I'll bring up to you is the first quarter GDP numbers in the United States will probably be very weak, maybe even negative. And the reason is because of trade. Trade or the net export number. That anytime we import something, a car is made in Japan and we import it into the US, the way that the GDP calculation goes, that's considered lost GDP. It was made somewhere else in their GDP. If we make a car in the US and export it to Europe, that's GDP here. So what you saw in December and January and February was a massive surge of imports. Why? Because tariffs are coming. So if you need something, import it now. So we had this massive surge of imports. We had this hugely negative net export number. That is a big drag on the calculation of GDP. So you're probably going to see a very weak GDP number, but that's because of exports, not because of the consumer. By the way, the converse of that would be presumably if everybody rushed their orders in December, January, and February to get them in before tariffs, what does that mean about their orders in March, April, May? They're probably going to be very light. I already imported it. I don't need to import it again. That net export number should rebound, and we might see a very, very strong second quarter GDP number to offset that very weak first quarter number. So you look at all these machinations between tariffs, the uncertainty, the stock market correction, the changing business models. I think if you could sift through that, and admittedly, it's not easy, the economy is doing okay. This consumer, I think, is still hanging in there.
Scott Bessent has said that the US economy is going to experience some pain, and he said there's no guarantees that the US will not go into a recession. What are your thoughts? Do you think the US goes into recession this year?
I don't think we're going to have a recession this year. I understand that there's an argument to be made for slower growth, and I get the pain argument. Let's talk about what he talks about with the pain argument. The US federal government's budget is $7 trillion. That's 23 or 24% of GDP. That is the highest non-crisis peacetime budget ever. In other words, the government is 23 to 24% of US GDP. When has it been more? 5 times in American history. The COVID shutdown response. Okay, that makes sense. The financial crisis shutdown response. That makes sense. World War II, World War I, and the Civil War. That's it. This is the first time we've seen the budget this big when we haven't had a crisis or a major war going on. That's unsustainable. That needs to be reined in. The $2 trillion deficit needs to be reined in to slow down the growth of the $36 trillion debt. Now, the problem is Bissett has also used the word, detox, in that the U.S. economy has been driven along by government spending. We're going to see less of that government spending. That's going to slow the economy. But their plan is by deregulating and by holding the line on taxes, keeping the Trump tax cuts, making them permanent, that should spur private sector spend growth that should offset the government growth. Now, the problem is it won't be one for one. For every dollar we lose of government, we're not going to get a dollar of private sector at the same time. There might be a timing difference there. So that's what I think he means by the adjustment. And I fully see that potentially happening. But I don't think that, at least right now, I don't think that's going to trigger us into a recession.
So there's a lot of chatter now for lower interest rates, and the Fed has signaled that there's going to be two cuts this year, but there's people out there they're asking for more because they want to stimulate the economy, including the current administration. Do you see that happening? And how do you balance that if you have a problem getting inflation down, but at the same time the economy is starting to stall and you want to stimulate it? How does he balance that?
That's a problem because if you go back to last September, the Fed cut rates by 50 basis points, followed up with a 25 basis point cut in November, 2 days after the election, and another 25 basis point cut in December. What did long-term interest rates do? They went straight up during that whole period. And they went up over 100 basis points. Now, what you could argue is the administration is trying to blame it on Trump. It was because Trump won, and it was because Trump was bringing in tariffs. But this move up in rates started in September with the rate cut by the Fed when Harris was leading in the polls. So I think really what it was, and this is the issue we have to deal with, the market is concerned about inflation. When the Fed is vigilant about inflation, and let's go back to 22 as an example, they were raising rates 75 basis points a meeting when we were getting 9% inflation. But yet throughout all of 2022, the highest the 10-year yield in the U.S. ever got was 4.22%. Today, as we're talking, it's 4.3%. It's higher now than it was at its peak in 22. Why? Because in 22, if the Fed is raising rates 75 basis points a meeting, even if we have inflation, I can relax. They're on the case. In 24 and in 25, when I'm still worried about inflation and they start cutting rates and they're not vigilant about inflation, get me away from the bond market. Yields went as high as 475 in January. And now, like I said, they're 430 to 435, somewhere in that range right now. So I think that's really the issue. So when you ask, what does the Fed do to lower interest rates? I actually think that the answer might be raise the funds rate, and you might see a lower 10-year note. Because if you lower the funds rate and stimulate why we have inflation, you'll get a bad reaction on the bond market. But if you raise the funds rate and perceive that you're being vigilant about inflation, you might produce a lower level in the 10-year. Now, I know that's a non-conventional thought, but look at the way the markets have been trading the last couple of years. But what my real fear is that if they just decide this is it, we have to now start quantitative easing, we have to start cutting rates, maybe we go back to zero. This is not the 1.5% no inflation world of 2010 to 2020. This is a 47 months above 3% inflation world that we've got right now, with inflation not showing signs of slowing. And if you're going to pump massive stimulus into this economy, the bond market might have a very, very bad reaction. The stagflationary reaction that you hear people talk about. Stagflation meaning weak growth and high inflation. And that's probably one of the worst cocktails for the bond market. So that's the risk that we have with it right now.
Jay Powell's term ends in 2026, which I guess is not too far away, but are there any circumstances which would lead you to believe he might not finish his term?
Not finish his term, no. I mean, other than a health reason, I think he'll finish his term. I don't think Trump will fire him because Trump's got enough things on his plate. He doesn't need to add that. His term is up in May of 26. So his term is up in roughly 14 months. I don't think that there's a scenario where Trump reappoints him. I am a bit of a fan of Jay Powell. I wouldn't mind him being reappointed, but I understand that he won't be. And 2 terms, 8 years is enough anyway. So it's not like there's some great crime being committed by not reappointing him. I do think, though, that there is a scenario out there that I'll throw out at you that Trump could do. And that's what Scott Bissett has talked about, what he called about the shadow Fed. Look, if Powell's term is done in May of 26, and you really want to fire him, but you really don't want to have that on your plate on top of everything else that you've got going, why don't you in May or June of 25, like in the next 2 to 3 or 4 months, announce way ahead of time who his replacement is going to be? And then his replacement could go on financial television, Bloomberg, CNBC, Fox Business, and sit there on Fed meeting and basically armchair quarterback everything that the Fed does. So then we could get the market start thinking, don't pay attention to what Powell, the current chairman, says, pay attention to what the next guy thinks, and kind of, take the spotlight off of Powell and maybe change the narrative around the Fed. That is an idea that has been floated. It's a way that Trump could, do, like, not fire him, but effectively take, like I said, take the spotlight away from him. And I think that's a more plausible idea than worrying about whether or not he'll finish his term. Like I said, short of health, I think he will finish his term.
I have heard you speak quite often about this Mar-a-Lago Accord. Can you just take us through that and what exactly do you mean by it?
So let me explain it this way. Do you think the United States federal budget, federal spending is at a crisis moment? Trump thinks it is. Trump's cabinet thinks it is. His advisors think it is. And his 75-ish million voters think it is. So they start from the premise that the status quo cannot maintain. We cannot talk about $7 trillion budgets, $2 trillion deficits, $36 trillion in debt. When we lift the debt ceiling, let's go to 40 or 45. We cannot do any of that. So that's off the table. We have to do something different. We have to bring down the budget deficit. We have to rein in the spending, and we have to correct the imbalance that globalization has caused. Globalization is, look, I'm a fan of globalization. I understand what we've seen over the last 30 or 40 years with globalization. But let me give you some uncomfortable numbers. It's been a very difficult part for the middle of the country. 65% of the American public does not get a college degree. 35% does. Those 65% that don't get a college degree have a 7-year life expectancy less than those with a college degree. Now, why is that? They drink the same water, they eat the same food, they breathe the same air. So why do they live 7 years less? That's deaths of despair, as Ann Case and Agnes Deaton at Princeton University have been highlighting for the last decade. It's alcoholism, it's liver disease, it's suicide, it's drug overdoses. Why is this happening to them? Because their industries, their jobs have been sent overseas. Deglobalization has hollowed out manufacturing, heavy industry, construction, basic materials and the like. And so Trump is coming in and correctly saying that in addition to this deficit that we've had, and in addition to this government spending that we've had, globalization has exacted a huge toll on the American public. And he's right about that. Now, what do we do about it? We've had these arguments about worker retraining, which has been, slandered them by saying learn to code or go back to school or something like that. But that's not their lifestyle. That's not the way they live their life. So Trump is now saying, I also want to engage in policies that maybe will lower the value of the dollar, but maintaining its reserve currency status, making our exports more competitive, making imports higher in price, and that hopefully correct that imbalance. No less than Lloyd Blankfein, the Wall Street Journal, said, Lloyd Blankfein is the former chairman of Goldman Sachs, said that maybe we should think about what Trump is trying to do. And sure, it might add a couple of $1,000s to the cost of a car. I'm quoting Lloyd Blankfein. But if it creates hundreds of thousands of jobs that are jobs that a single earner can raise a family on again, like they could have before globalization, it might be worth it in the long run. So this is part of what is the premise of the Mar-a-Lago Accord, which is a paper by Stephen Miller and his Council of Economic Advisors, Trump's Council of Economic Advisors, about reworking the financial system, reworking the global trade order, because we're at a point that we cannot do the status quo. We cannot continue the way we were. Today in the Financial Times, Robert Armstrong said, "I thought the Mar-a-Lago Accord was a dumb idea, and I'm glad to see it's dead." Well, first of all, I don't think it's dead. I think it's already been implemented, and I'll talk about that in a second. And second of all, the idea that I think it was dumb and dead, what do we do then? We just go back to $7 trillion deficits. Sorry for you guys in Cleveland. You can't get a job and you're all dying of drug overdoses because you've got no opportunity. That's just the way it goes. I'm saying this in difficult ways to try and get the point across. What do we do then without it? Because Trump thinks we cannot go back that way. So they're trying to lower the value of the dollar. They're using tariffs as leverage to try and reorient the financial system. That's why tariffs come on and off all the time. And the other one, the big part of the Mar-a-Lago, so those are parts of the Mar-a-Lago Accord. When he says it's dead, it's not. They're doing that. But the other big part of the Mar-a-Lago Accord has been security. So the U.S. has $36 trillion of debt. Where did all that debt come from over the last decades? The argument is the U.S. has been the security umbrella of the world, that they fought, the U.S. military was the primary point to take on communism and then take on terrorism. It has been the lead in every war since the end of World War II. Whether you're talking about the Korean War all the way up to Afghanistan, it's always been the lead, and it's racked up trillions of dollars of debt. So the argument is that our allies have gotten a free ride over those many years, and our allies need to start thinking about paying for it. And in the case of Europe, they've agreed. And in the case of Germany, they've lifted their debt brake. In the US, we would call that a balanced budget amendment. So they could deficit spend. They've promised that they're going to spend $500 billion on defense. Europe is going to spend $3 trillion on defense. I was looking at this morning. The best sector in all of the world you could have owned this year is European defense stocks are up 80% since January 1st. Number two, by the way, is gold stocks up 35, less than half of what European defense stocks are up, because they've agreed to this. So when Armstrong says, no, it's a dumb idea and it's dead. Well, first of all, it's not a dumb idea to think that we were at a point that the status quo couldn't hold. But to say it's dead, no, it's all happened already. It's all happened. Europe is going to pay for more defense, that they're going to shoulder the burden from the U.S., and he's using tariffs to try and reorient the financial system, or the trading system, excuse me, to lower the value of the dollar, to hopefully bring back manufacturing jobs. Just 2 days ago, Hyundai, the world's largest steel maker, announced plans to build a steel plant for the first time ever in the United States. So we're starting to see the fruits of this Mar-a-Lago Accord. So I'll come back to the beginning. Do you think we were at an unsustainable crisis? Trump thinks yes, his advisors think yes, his voters think yes. So we cannot continue to do what we've doing. If you don't like this program, then give him a Mar-a-Lago 2.0. Don't just tell him to go back to $7 trillion budgets, because we're not going to do that.
And if the current administration is successful in implementing this new world order and this economic alignment, what does that mean for the global economy? And especially given that the U.S. is the world's largest economy, representing 30% of global GDP. China is the second largest at 20%.
I think it means a realignment closer to values. So I'm going to have to go a little political on the first part of this answer. When J.D. Vance went to Munich last month and spoke at the Munich Security Conference, I'll summarize what he said. The U.S. for decades was spending 5-8% of GDP, especially during the Cold War, to fight communism. Europe, the NATO countries, were spending 2%. And Canada was spending even less than that, because Canada felt like it fell under the security umbrella of the United States. No one's going to attack Canada because the U.S. won't stand for it. So they didn't have to spend as much. Consequently, Europe and Canada spent more on other priorities like national health care, green movements, and the like. The U.S. wasn't afforded to do that because they spent so much on defense for many years. So priorities between all these countries diverged. And that's what Vance was trying to say. What Europe wants, what Canada wants is different than what the United States wants, because the United States has been security first. Europe, Canada, the NATO countries haven't been. So if this is successful, it will bring them back into line with each other, because we'll both have a security arrangement. We'll both have social policies that are going to be very similar to each other. And I think that if we bring ourselves back in the line and we reorient the global trading system, it can be a net benefit, especially against Russia, China, Iran, North Korea, and all of the other foes that we seem to have. It can be very successful. Last word for you about this. As you mentioned at the top, I'm in Sonoma Valley, so about 2 hours north of Silicon Valley. Silicon Valley is famous for people go there with great ideas and they don't execute, and those ideas never see the light of day. What Trump is trying to do, I would honestly tell you, in a vacuum, I don't think it's necessarily terrible, especially the tariffs, if he uses them as a point of leverage. But he has to execute on it. If he doesn't execute this idea, it will end badly. If he executes this idea properly, it could turn out very well. And that's really what the volatility, the uncertainty, I think, is about, is can he kind of pull this off? And this is what we're going to find out over the next 4 years.
And because of the uncertainty associated with this economic realignment, we got a lot of volatility in the financial markets. The S&P, let's just say it's down 10% on the year. You mentioned how strong some of the European markets are. The German market, the DAX, I think it's up 15% on the year. I'm not sure if that's where a lot of those defense companies are located, but do you think this trend continues? Do you see a further pullback in the S&P and more money flowing into these European markets in the coming months?
Well, I think that, so two things. First of all, in the US, of course, we've got the concentration of the Mag 7 stocks, and those stocks have really been dragging down the overall index. So it's been the inverse of the last couple of years, where the Mag 7s have pulled the S&P higher. It's really kind of dragging it down quite a bit. And I think that given those high valuations of those companies and huge expectations that AI is going to be more important than the internet itself, those lofty expectations can easily be disappointed. And I think that those stocks are going to continue to struggle. That's not to say that the AI boom won't, produce what everybody hopes. The famous example that I've been using is, let's go back to the late 1920s, RCA, Radio Corporation of America. Everybody thought, man, we're going to have radio where every house in the country is going to have a radio. President's going to be able to speak once and everybody's going to be able to hear his voice. And we ran the stock up to a 200 PE. It took 40 years for Radio Corp of America to basically take out its 1929 high. That didn't happen until the early 1960s. But in the process, every house in the country did get a radio, and every house in the country did hear the president's voice. And then they got a black and white TV, and then they were starting to get a color TV by the time that Radio Corporation of America started to make its new high. So when it comes to the Mag 7 stocks, let's not confuse that there's this big AI boom coming, and maybe it will be transformational, but that might already be in the stock price. And it better be a big deal. Otherwise, those stocks could disappoint. Now, on the Europe side, Europe was benefiting from two things that is kind of interesting. One, even more concentration than the US. SAP is 16% of the German stock market. The 10 stocks in the German stock market are 60%, 60, of their capitalization. A lot of these are basic material, heavy industry kind of companies as well. And then when you go out through the rest of Europe, you get the Airbuses in the world and stuff into those. So European stocks have struggled mightily. So they're very cheap, like to say cheap for a reason. And then you bring in all this deficit spending for things like industry and defense. And these are their big companies. They don't have big, they don't have big tech companies in Europe. They have big, heavy industry companies. And so these companies are all starting to take off because of infrastructure and deficit spending. So they're cheap, they've got the spending going, and they've taken off. So I think this rotation makes sense to me why it's happening. Is it the end of American exceptionalism and the beginning of European exceptionalism? I think that's kind of overstating the case. But nevertheless, there's a bunch of cheap stocks that are getting some stimulus, and you've got a bunch of expensive stocks that better live up to the hype. And that better, I think, explains what's going on between the two.
So you and I are like neighbors. You're in Chicago, I'm in Toronto, and so you're well acquainted with the Canadian economy. And as you know, we have a big federal election coming up here. Any thoughts on the Canadian economy and the election?
Well, I know that the Canadian economy has been struggling quite a bit, and I know that there's been some unhappiness. So, a couple of thoughts for you. I know Carney because he was Bank of Canada and Bank of England, and I've been using the overlay with his as what we saw recently in our election. We got rid of Biden, and we replaced him with Harris. And Harris was initially doing very strong in the poll because her name wasn't Biden. And then eventually people started to look at Harris, and then slowly by October, the polls started to shift in favor of Trump. Carney's polling well, largely because his name is not Trudeau. And the question is, as people start to ponder whether they're going to pull the lever for him on April 28th, is that good enough that you're just not Trudeau, or do you have to be something more than that? So Pierre Poilievre, I think, has been struggling in the polls for that. And of course, you've got your dominant issue now about, Trump in the 51st state talk and stuff. I personally think it started off as a troll. Trump didn't like Trudeau, so he was trolling him by calling him the governor. And we all thought it was really funny. But then when he said it for the 15th time, I can understand why Canadians thought it was funny the first time and got really mad by the 15th time and started booing the national anthem at hockey games. We'll see where this goes after the election, because calling me skeptical that 51st state talk will ever amount to anything other than it was a troll against Trudeau that kind of got a little bit out of hand. And I think once we start to, the real question is the Canadians are going to have to ask is, what does Carney mean? And do you want that policy for the next 4 years? Considering where you've been over the last 8 or 10 years. So kind of giving you implicitly giving you my view on it. But it's been a fascinating subject to watch as we move forward. And if we start to see a return of manufacturing in the US, and we start to see after all this deficit talk and all these tariff talks, maybe we get back to some kind of free trade agreement. I think both countries could be a winner and still remain both countries, and not just the 51st state can be a winner in this as we move forward.
Well, Jim, that was a great discussion as always, and I want to thank you very much for spending time with us today. If somebody would like to follow you online or check out your various services, where can they go?
Two things. BiancoResearch.com is our website. Bianco Research on Twitter X, Bianco Research on YouTube is where you can find me there. On the other side of the equation, we do manage a total return fixed income ETF index. You can find out about that at BiancoAdvisors.com. And you can also look it up on your Bloomberg. There's an ETF that tracks a WTBN. Wisdom Tree is our partner. So it's the Wisdom Tree Bianco Nancy WTBN is the fund there too. So if you're in the market for a total return fixed income ETF, we have one, and I, consider it.
Once again, thank you and enjoy Sonoma.
Thank you.